The stock market is experiencing a dramatic downturn. Investors are selling shares at a rapid pace. Major stock indices have plummeted, with the S&P 500 experiencing its largest single-day drop of 2025. This decline has wiped out trillions of dollars in value. The Nasdaq Composite, heavily weighted towards technology companies, has also suffered a significant fall. This market sell-off is a global phenomenon. European and Asian markets have followed suit, reflecting the interconnectedness of the global economy. The speed and severity of the decline have taken many by surprise. It serves as a stark reminder of the inherent volatility of financial markets. Market corrections, while unsettling, are a normal part of the economic cycle. They can present opportunities for investors to buy stocks at lower prices. However, this particular downturn is fueled by a confluence of factors. Understanding these factors is crucial for investors seeking to navigate the current market turbulence. The technology sector, once considered invincible, is bearing the brunt of the market sell-off. Apple and Nvidia, giants of the industry, have seen their share prices plummet by around 5%. Tesla, the electric vehicle maker, has suffered an even steeper decline, losing billions in market value. This decline can be attributed to several factors. Investors, once enamored by the growth prospects of tech companies, are now reassessing their valuations. Rising interest rates and inflation are making it more expensive for these companies to borrow money and invest in future growth. Additionally, concerns about regulation and increased competition are weighing on investor sentiment. The fall of these tech giants is a sign of the times. It suggests that the market is shifting away from growth stocks and towards more value-oriented investments. Investors are looking for companies with strong fundamentals and a proven track record of profitability, rather than those promising future potential. The current market turmoil is not solely due to internal factors within the tech industry. Broader economic uncertainties are playing a significant role. Trade tensions, particularly those stemming from President Trump's policies, have escalated, creating a climate of uncertainty for businesses and investors alike. Tariffs on goods from China and other countries have disrupted global supply chains and increased costs for businesses. Retaliatory tariffs have further exacerbated the situation, leading to fears of a trade war. The uncertainty surrounding trade policy is making it difficult for businesses to plan for the future, leading to reduced investment and slower economic growth. Adding to the unease are concerns about a potential recession. While President Trump has downplayed these concerns, some economists believe that the U.S. economy is headed for a downturn. Slowing global growth, rising interest rates, and trade tensions are all contributing to this pessimistic outlook. Section 4. Delta's warning shot. A canary in the coal mine? Delta Airlines, a bellwether for the airline industry and the broader economy, recently cut its profit forecast for the coming quarter. The company cited heightened U.S. economic uncertainty as the reason for the lowered expectations. This move by Delta is a worrying sign for the U.S. economy. The airline industry is highly sensitive to economic downturns, as businesses and consumers tend to cut back on travel when times are tough. Delta's decision to reduce its profit forecast suggests that the company is anticipating a slowdown in economic activity. Investors are closely watching for similar moves by other companies. If more businesses start to lower their earnings forecasts, it could further fuel fears of a recession and lead to deeper declines in the stock market. Delta's warning shot is a reminder that the current economic expansion, while lengthy, is not immune to the cyclical forces that have shaped markets for centuries. Section 5. Government gridlock, adding fuel to the fire. Political uncertainty in Washington is further exacerbating the situation. The Trump administration's confrontational approach to trade and other policy matters has created a climate of unpredictability. This uncertainty is making businesses hesitant to invest and hire, which could further dampen economic growth. The recent government shutdown, while short-lived, highlighted the dysfunction in Washington. The inability of Congress and the President to agree on a budget created unnecessary uncertainty and disruption. Investors are concerned that further government shutdowns could occur, adding to the already heightened levels of anxiety. The Trump administration's rhetoric regarding the stock market is also causing concern. Some officials have suggested that the administration is willing to tolerate a market decline or even a recession in order to achieve its policy goals. This stance has left investors wondering whether the government is prioritizing the stock market's performance or pursuing other objectives that could have negative economic consequences. Section 6. The Wealth Divide, a tale of two markets. The current market sell-off is unfolding against a backdrop of widening wealth inequality in the United States. The top 1% of Americans owns a disproportionate share of stocks and other assets, while the bottom 50% owns a very small fraction. This wealth gap has significant implications for the stock market and the broader economy. When the market is doing well, as it has been in recent years, the benefits accrue primarily to the wealthy. This can exacerbate income inequality and lead to social unrest. Conversely, when the market declines, as it is doing now, the wealthy are generally better positioned to weather the storm, while those with fewer resources may see their savings depleted.